Hey, what's up, everybody? Joe Steele here, Crypto in the House, and bringing you the latest in cryptocurrency and real estate news. Today is Saturday, August 13th, and wanting to jump right in. Not a crazy day out there, but some interesting stories worth sharing. First being Paradigm partner with FTX to launch one-click future spreads trading. Basically, Paradigm and FTX can now trade the spread between the spot, perpetuals, and future maturities on Bitcoin, ETH, Sol, AVA, Ape, Doge, Link, Litecoin with a single click, no leg risk. Saying spreads trading is an efficient way to execute multi-leg delta neutral strategies without execution risk or order book impact, regardless of your trade size. They're saying it gives you 50% less fees than trading individual outrights on FTX. And this is the third exchange to partner with Paradigm on future spreads. So basically, they're calling it a major step toward the development of liquid interest rate curve in crypto. I saw Sam Bankman-Fried of FTX retweet this article earlier. So thought it was worth sharing since he thought it was worth sharing. Pretty cool whatever you think of spreads trading. But moving on to Reddit, it looks like a lot of people clearly were burned on Celsius, on Voyager, right? You name it. Lately, it seems like there's a lot of people that are hurting. So these users on Reddit, Telegram, Twitter are basically channeling their energy and forming a sort of a community around people who are burned by these platforms and helping each other out in terms of sharing, pulling funds for legal representation, it says, but sharing news and advice, which is very, very cool to see people come together and want to help each other out and make sure things like this don't happen in the crypto world. But unfortunately, they do. So I'll always be careful, but hard to know when some of these companies are out there telling you not to worry, not to be concerned, your money's safe. And obviously they go into these bankruptcy cases. So whatever it's worth, at least people are feeling that they have others to listen to and can help each other out, make each other feel a little bit better about what they may or may not have lost in these recent mishaps in the crypto industry. Ripple, who is not a stranger to their own sort of inner, dealings with the SEC here in the United States. They're basically saying Ripple Labs is interested potentially in purchasing assets of the bankroll crypto lender Celsius, according to a company spokesperson. Looks like Reuters might be reading between the lines of what may or may not be an official announcement at some point, but the spokesperson said, we're interested in learning about Celsius and its assets and whether any could be relevant to our business, declining to say if they're outright interested. But again, deducting that, it sounds like there's certainly interest there. So maybe they're waiting for their own sort of dealings with the SEC to figure out what to do or what they can do with Celsius in their Chapter 11. So interesting, though. Riot blockchain based in Texas. Kind of an interesting story here in Yahoo they put out a statement, Yahoo covered, that they actually cut its energy use, but were able to take those power credits, even though they didn't mine as many Bitcoin this year. The mining credits actually helped them come out above, ahead this year. Basically, they produced 318 Bitcoins this year, which is 28% down from last year. But those power credits came out to about 439 Bitcoins, averaging about 21,600 or so that last month. And they also sold 275 Bitcoin, generating net proceeds of a little over $5.5 million. So this Texas heat wave was pretty nasty for many Texans, but clearly Riot was able to profit off of that, not in a negative way, but because of the where they're located and the power credits they took, that it was hey, that's a great thing for their company and it keeps them afloat, and they were able to sell some Bitcoin and use the power credits to make up the surplus or the difference. So either way, not a bad thing for Riot. Moving into some real estate. NBC News put out a story saying the U.S. housing affordability falls to a 3-decade low. Looks like around 1989. They're basically quoting data from the Federal Reserve Bank of St. Louis, looking at the Western U.S. as the most challenging area to buy a home because you need about $140,000 of income required for that conventional 30-year mortgage. They're saying mortgage rates and home prices have surged, but the income growth crawls at a much slower pace. I pulled up the chart here from the St. Louis Fed, so you can kind of see from 1965 through 2022 where that median, sales price of houses sold, just kind of get a visual on that. And I'll link a description to all these stories. And if you're getting value from this content and you like hearing about crypto and real estate, two of my favorite topics, maybe you'll subscribe to this channel. I do these streams every day, and would love to check your comments out in below, and kind of interact with you and see what you think about what I'm doing and how I can make things better here. Finally, I'm going to end with a story from Grant Cardone in CNBC, a guy who most people sort of connotate with real estate, but he's talking here about his own personal, primary residence. Don't buy a home unless you can afford to waste money, according to him, saying he still supports home ownership. He owns 3 homes, but he rents 2 of them out, and one is his primary residence. But it takes money out of your pocket. He's going to break it down. I'm going to show you how he breaks it down. He still believes buying a house is not a wise investment with the rise in inflation and high home prices. So it's point number 1 of 3. Home for 100 grand, put 5 down. 10 years later, you sell for 200. Looks like you made a ton of money. You turn 5 into 100 after you pay back your mortgage. But then you're looking at these costs of, hey, 10 years of interest, your 10 years of taxes, your real estate fees. So basically you're at 86 grand before you even look at like maintenance CapEx from there. Number 2, no cash flow makes you dependent on the market. So what he's big into is monthly passive income, clearly because he does commercial real estate, and those apartment buildings are cash flow centric. That's what they're about. They're not about appreciation. They're about the cash flow. So when your home doesn't provide the monthly cash flow, is always tied to having home buyers qualified to buy and who likes your home. You pay to live in it while you wait to maybe make a profit. Basically, when he goes to sell rental property, he only needs to find someone that makes a profit. That's not hard to do. And that's true. A lot of investors, as well as commercial buyers, they don't care. They're just looking at math. They're not attached to where they might see their kids grow up, or where they want to have their dog run around the backyard. Emotional. There's no emotional tie to this commercial world. And that's where I think he's coming from here versus the residential world, where it's a lot of it tied to appreciation and in terms of the emotional connection people will feel with these purchases. So only when you can find the trophy property that's selling below its value can afford to pay in cash, 99% certain there's a profitable exit due to the surrounding market. And finally, saying the limited tax benefit compared to commercial. Again, he's a big commercial guy versus residential. So he's saying you're only allowed a tax exemption of $250,000 gain on the sale of a single family every 2 years. So before you go investing in your house to invest in income producing real estate, those tax benefits skyrocket. So rental income gets taxed, but there's certain expenses you can deduct on your returns. According to him, mortgage interest, taxes, and operating expenses, depreciation, and repair. So his tip is to make passive income off of real estate. You invest in rental properties with favorable tax situations. So that his opinion, his sort of summary: don't buy a home unless you can afford to waste money. It's a place to call your own, provides stability, but there's so many better options, according to him, with stock market, obviously commercial. Doesn't believe it should be part of the American dream. It should be a place to live, and just people should know there are always costs attached. People like Uncle G and what he has to say. I'm a big fan of his too. I get where he's coming from. Some people, they have, that's all they can afford. They can't afford to invest in passive investments and things like that. So they might want to just keep that home, keep it in the family, pass it down. And there's generations that never leave the same house from 80 years ago. To each their own, but he definitely gives great advice when he does. He's very smart and knowledgeable. So I think that there's always some benefit in listening to people who may have a different opinion than you. And you might like residential real estate, you might love commercial. But either way, it's always worth checking out other people's opinions. And that's why I sort of, went into this story tonight, and I thought it was pretty cool hearing his feedback there. So with that, I hope you all have a great rest of your night. Again, please consider liking this video, subscribing to this content, and I do these every day. Crypto and real estate, try to split them half and half for this stream, because there's, again, two of my favorite, passions, investment vehicles. None of this is investment advice, of course, but again, if there's something you could learn here, this is just more what I see in the news that I think is relevant. So hope you all enjoy this again, and I hope to see